Good morning. Today is Wednesday, June 17th, and this is another edition of the Market Commentators, a podcast brought to you by the Milwaukee Company. My name is Matt Salm. I'm an investment analyst at the firm, and joining me this morning, as usual, we have Andy Wilms, who's our president and CEO, as well as Mike Wilms, who serves on our wealth management and portfolio strategy teams. A quick reminder that nothing in this podcast should be interpreted as investment advice. And with that, good morning.
Good morning.
Good morning, Matt. Good morning, Andy.
Good morning, Mike.
So this past week was a bit crazy in terms of the stock market. Do you want to walk people through some of the highlights, Andy?
Yeah, well, if we look at last week, stocks posted their first weekly loss in a month, with mostly attributable to a very steep sell-off on Thursday, as traders appeared to get increasingly concerned about the rising number of coronavirus cases in some states. And adding to the fears was a grim forecast by the Federal Reserve on economic activity in the near term, which put together, led to suggestions that maybe the market really had gotten ahead of itself. Well, nothing like a weekend to make people change their point of view, because although the market fell at the open by about 750, 760 points, or around 3%, it changed direction sharply and ended up 150 points higher as basically an announcement that the Federal Reserve will start buying individual corporate bonds. Up to this point, it's just been investing in corporate bond ETFs. And then yesterday, the market continued its surge after retail sales data showed that retail spending was improved by more than or approximately twice what the analysts were expecting. If you're not worried about the budget, there's more good news from the form of the Trump administration announcing that it was looking to spend $1 trillion on infrastructure, something I would have suggested might have been done much sooner. And there was also an announcement that there was a commonly available steroid that might help critically ill patients survive the virus once you're on a respirator. If you're getting artificial help breathing, that this could really improve your odds of living. When you get right down to it, it seems like the slew of more positive economic data combined with additional stimulus news has at least temporarily diverted investor attention from the signs of increasing coronavirus cases in some parts of the country. It also looks to me like Mr. Market has kind of ignored Federal Reserve Chairman Powell's testimony yesterday that there was significant uncertainty regarding economic recovery, and he said much of that uncertainty stems from the path of the disease and how successful we are at containing it. Wall Street analysts overall, at least as of last week, were cautious about how much the market could go up for the rest of the year, with the consensus year-end target as of about 3,000 as of Friday, which was nearly for the S&P, thank you, which was nearly 150 points below yesterday's close, or 125 points below yesterday's close. So the bottom line to me is that the market is just as confused, or Mr. Market is just as confused as everybody else as to what's to happen next. There's really no clear way of predicting, in my mind, with any certainty what's going to happen. It all depends on, so much depends on what's going to happen with the virus and its spread, and that's still somewhat questionable. Can you shed any light on that, Matt?
Yeah, I guess in the U.S., as you mentioned,
No pressure.
Yeah, a decent number of states are seeing increasing cases. Looking at data from Johns Hopkins, I thought it was actually interesting that across the country, the daily rate of new cases is basically unchanged since the first week of May, but where those cases are happening has changed drastically. Right, so in some places, such as across the Midwest, new cases have been declining as other hotspots have been popping up, as you read about in the news, Arizona, Texas, etc. But outside of the U.S., things look, again, decent in some parts of the world, concerning in other parts. Brazil just had its highest number of new cases in a single day reported yesterday at over 35,000. But there are, promising developments on the medical front at the same time. The United Kingdom, in particular, I know, released a study on dexamethasone, I believe is the name of the drug, that they said looked, very promising. I think you referenced it earlier, Andy, for helping out critically ill patients.
Well, I think one of the things that's important to keep in mind is that if you go back to when the virus was first being recognized as a problem, testing in the United States was only about 8,000 tests a day. We're now up to over 500,000. And that's a reason for more and more cases or a elevated level of infections being found by the medical community. And so there theoretically could have been a drop in the actual infection rate, given the large percentage of the people that contract the virus are asymptomatic. But the testing would pick up someone that has the virus, whether they're asymptomatic or severely ill.
Yeah. Then again, how many people who are asymptomatic are going to get the test? I mean, if you're asymptomatic, what's going to lead to you even getting the test in the first instance? It would seem to me that only people who are symptomatic are going to seek out the test. So the fact that there's a lot of people who are asymptomatic running around out there, that doesn't, in fact, you're testing more doesn't really matter, right? Because we're not
some
testing.
Of the people here have gone and been personally tested and paid, I think it's like $150 to be tested. And it's not that they have any symptoms or anything else, but they just simply wanted to be tested.
Oh, okay. Well, I wasn't aware that there's a large number of people doing that testing, regardless of whether they're symptomatic or not. So that's very interesting. Mike, you mentioned before that we started the podcast editorial by Vice President Pence that, along these sort of lines, because we tend to talk about the things that we know that are problematic because that's sort of what affects markets. But the editorial pointed out some things that were positive that may not have gotten the attention he felt they deserved.
What the editorial in the Wall Street Journal talked about was the massive sourcing of personal protective equipment, gloves in the billions, masks in the billions, the fact that no one in need of a ventilator through the entire pandemic has been denied or unable to receive access to a ventilator. There's already 30,000 excess ventilators in the federal government's stockpile. And talking about that increase in testing to 500,000 a day, and that there is a capacity to test more, but that's the indicated need for testing at this point. There's just been a lot of infrastructure and resources brought into this to provide the type of treatment that someone potentially might need.
So from an investor's standpoint, I guess the good news on that side is that if there may not even truly be a second wave, what we're calling a second wave, at least at this point, may be simply a matter of increased testing. And I don't find surprising, because I think the second wave we're talking more about this fall anyway. So if we keep a consistent level of testing and now the numbers do go up, there won't be any question about the fact that there is truly a second wave, maybe in the fall, maybe not. But the other potentially good news there is that we're better prepared to deal with it should there be a second wave. And the fact that all of us, I mean, virtually everybody has access to a mask now, if nothing else, would suggest that if there are signs of a second wave, we'd be better prepared to deal with it. Whereas when this first started, getting a mask was quite a trick. It wasn't so easy. But there are other things that are problematic too, right, Matt? I mean, not all the news is good, as you pointed out in your comments. So I think it's when you put the potential good and bad together, you're left with still a great deal of uncertainty as to how this is going to play it out. There's good reason for optimism that we could deal with we have better treatments, we have better prepared if there is a second wave. But there is also reason for concern that people aren't taking this as seriously here in some parts of the country as they need to be. And as a result, we could end up having the risk of a second wave increasing as compared to Europe, where, in Europe and in New York, you saw a much more dramatic spike up and a much more dramatic drop down, right? Because they're both locations that have been much more serious about trying to, social distance and kept the restrictions on a lot longer. In the rest of the United States, you've seen a much more gradual spike and a more gradual decline. So, at least as far as I'm concerned, from my perspective, any outcome is still on the table, although I continue to try and remain optimistic. And I think the biggest hope remains with the pharmaceuticals companies coming up with an effective vaccine in the fall. Or, in the near future, I should say, not in the fall, in the near future. If that happens, we'll be in good shape. But it's far too certain to say whether or not that's going to happen. So go ahead, Matt.
Oh, we were talking about the possibility of a second wave and how we might respond. I know one of the things we were going to discuss was whether or not certain parts of the economy could shut down again if there was a second wave. I know Secretary Mnuchin had some comments about that, saying that, we couldn't shut down the economy again, even if there were a second wave, because the damage would be so devastating. So I figured I'd ask your guys' opinion on that.
Well, I don't think it's off the table that we could shut down the economy again, right? I think we'd be less anxious to do it, and I think we now are better prepared to keep the economy going and still take precautions. We know much better how to prepare, take precautions. But if people are still being disregarding the precautions that should be taken, right? We still see a lot of the things that we've seen in Miami and in parts of Texas, and where people are just sort of, partying like it's. They used to say, 1994 or something? But anyway, wasn't that what Prince said? I forgot. Anyway, the point being that if people are careless, the government's going to have to step in and say, you people are not doing what needs to be done to stop it. We're going to have to force you. If people do a good job of being sensible, then I think the economy, we won't be so anxious to shut it down without giving people a chance to behave themselves, I guess is what I'm saying.
And I think that's true. I mean, the adopting of appropriate behaviors and appreciating that if you disregard the recommended safety procedures, you're not placing yourself at risk, it's everybody else. By and large, everybody rises to the occasion and does the right thing.
And, as you say that, Mike, it kind of brings a thought to mind. It's really, and that's what's going to determine what happens with the stock market in the long term, right? If we shut the economy down again or not is probably the biggest influencing factor. So it's interesting to me we say to ourselves, usually what's going to affect the market is economically based. Here, it's strictly on whether people behave themselves, right? If they're responsible or not. So as an investor, you're not looking at so much economic data. You're making a judgment on.
It's not necessarily something I want to have to rely on.
Yeah, it really that might very well boil down to what you decide to do. If you think you can count on people if you think people are generally going to behave themselves, then you'd be more optimistic in the stock market. If you think we are more of a reckless society, America's always been sort of, kind of that has had that since the frontier days, really. Then you might say it's better to be a little more cautious here with your portfolio.
Yeah, rather than looking at PE ratios, you just tally up all the people you see wearing masks versus not, and make make your investment
Well,
decisions based on
you
that.
know, that's not a bad way to think of it. Or you're trying to anticipate, right? You're forward looking. So you think to yourself, how do you think people are likely to respond? What are people more likely to do? So maybe if you're a psychologist, you'd be in a better position. Maybe that's who you should be contacting rather than an economist, is to decide what to do next.
That's interesting. Yeah. Speaking of optimism, a recent report from Morgan Stanley seemed to claim that we're already in a new expansion cycle for the global economy, and that contrasted pretty sharply with a lot of other research I've seen from organizations such as, the IMF, something you've mentioned, Matt, Andy, but not just the IMF, right? Like most economic forecasters, I think, would not have made such a bullish comment. So do you have any opinion on who is right there, Morgan Stanley or the IMF and everyone else?
Well, what do you think, Matt? Why don't you tell us what you think first?
Oh, I'm definitely biased towards a bit more towards the IMF's modeling, and also towards, I guess, like their incentive structure for, the things that they would publish and why they would publish. Obviously, it's.
Okay.
I mean, there's going to be politics involved in any organization, right? Publishing a bullish versus bearish forecast. I think Morgan Stanley has more probably to benefit from people feeling more optimistic and more bullish. And so they would want to try to create that type of atmosphere, versus the IMF doesn't have anything, I guess, to gain from things picking up.
Well, a couple of anecdotal examples here. So my son flew down to Austin, Texas yesterday, and had a connection from central Wisconsin to O'Hare, and then from O'Hare down to Austin. And the feeder flights into one of the hubs, the plane from central Wisconsin to O'Hare was completely full. Every seat, there was no opportunity to social distance. The flight from O'Hare down to Austin, about a third full. And yeah, a month ago, I would suspect both planes would have been close to empty. So you're seeing a spike there. I mean, going back to Andy's comments about retail sales that were announced yesterday, month over month, they were up 17.7% after having been down 14.9% in April. And you're starting to see the quote unquote green shoots of the economy starting to recover. So nobody can predict how fast it's going to be. And I can't tell you if the IMF is right or if Morgan Stanley's right. I do know the organization that spends the most on forecasting and historically is wrong more than they're right is the Federal Reserve. So that would be more the same kind of flavor as the IMF. And actually, I think Morgan Stanley benefits from market dislocations. They'd rather see the market crash again 3 or 4 times before the end of the year because in that volatility and confusion, there's profit for those kind of guys.
Oh, interesting.
And I guess I would take, so I think Mike is right about, I don't think Morgan Stanley's, I do think Matt makes an excellent point that, all of our forecasts are influenced by our personal biases, whether we recognize it or not. I don't know that Morgan Stanley has an institutional bias that would encourage them to be optimistic, though. I think Morgan Stanley's big bias is to be as accurate as possible because if they aren't accurate, it can be held against them. Then again, I think really the incentive is to be different. Morgan Stanley, if they come out with a call that is more optimistic than the consensus, and they prove to be right, they can get a lot of play out of that, a lot more play from that than being right on the downside with everybody else.
Well, and that's exactly right. It's not a matter of being different. It's being first with the call and being right because it's all reputational.
Right. And so my point being is, whereas being wrong, the reputational benefit of being first and right may be greater than the downside risk of being first and wrong. People tend to forget who was wrong, but they all remember, who did the long short on the stock market back in 2007, right? So they made a movie about them. You know what I mean? They make a movie about the guys who are
Yeah, well, and
they make a movie about the
Elaine
guys.
Garzarelli made a living on her call on the market back in the 90s for 20 years.
Exactly. So I think that would be more the reason. But, as our director of analytics would say, Jim Paserno, AKA the Capital Spectator, who I highly recommend his blog. Anyway, what he would tell you is it's generally speaking, the consensus is much more accurate than any outlying view. And so if I had to bet who is going to be right, I would tend to go with the consensus. And the consensus here is that this is going to be a slow recovery, not a deep economic recovery, not a sudden V-shaped economic recovery. And I suspect that, but that would be my best guess, but I would emphasize the word guess in that sentence.
Absolutely. Yeah, there's just profound uncertainty, right? And we don't have a crystal ball, that's for sure.
Right. That's right.
So with that, do you guys have any closing comments you'd like to share with our listeners?
Well, from my perspective, we've discussed the Federal Reserve, their view on a slower economic recovery. The one observation that I think is important to keep in mind, they're providing an incredible level of accommodation and support to the overall economy at the anticipated continued rate of purchasing assets. They'll be buying $20 billion worth of treasuries every week for the foreseeable future. I'm not sure if that's actually out to 2022, but at 20 billion a week, that's just under $1 trillion a year of additional cash that will be coming into the economy, and that obviously is very accommodative.
Absolutely.
And, if you're a long-term investor, it's important to keep a long-term perspective on all of this. We're all very, very focused on what the government should be doing and what can be done to stimulate the economy today. But I think it's very important to maintain a long-term perspective in here, because I do believe some of these measures could have very long-term consequences. And so you want to position yourself to deal with the prospective long-term consequences of what the Fed has done and what the Congress has done and so on, as well as what might happen in the next 6 to 12 months.
Yeah, I think that's absolutely correct. My last comment was going to be, there's certainly going to be a lot of negative headlines still over the next couple of months. And don't let that scare you away from your long-term investment objective, and also don't let it detract from trying to see the full picture. Because there will be some volatility, there will be some bumps in the road, but that doesn't mean that things are all going downhill. So,
very good.
With that, thank you everyone for joining us. If you enjoy this, please consider subscribing to us on Spotify, YouTube, or wherever you get your podcasts. As a firm, we also produce a weekly newsletter that we distribute on Fridays, so check that out if you enjoy this content. And then please consider following us on Twitter at The Milwaukee Co., where we post a variety of things related to finance and investment. So thank you again for listening, and thank you, Andy and Mike, for joining.
Thanks guys.
Matt.
Have a good day.
Bye.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an